All right. Thank you everyone for attending this month's market update webinar for the month of October. Let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within this presentation. My cat Citrus just came to say hello. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures. And throughout the webinar, please submit any questions you have using the Q&A button at the bottom. A quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, certified private wealth advisor, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in personal financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial, the firm, is a fee-only fiduciary RIA. We provide comprehensive wealth management services, including financial planning, investment management, tax prep, estate planning, and so on. You can learn more about us on our website. All right, let's start this month talking about the markets. This month was interesting. Last webinar we had, the beginning of September, I had been warning some caution because we had really good months previously where we might be giving up some gains. If we had some bump in the road that came across, it wouldn't have been surprising for the market to have reacted poorly this month, simply because we had such great months before, and you don't want to go over your skis, as the expression is said. But I was proven wrong, or at least my caution that I had presented didn't have to be said. We had a pretty good month of September, where the Dow Jones, S&P 500, mega cap stocks, they were all around a 2% return for the month. And September, which we'll get to in a little bit, September historically is the worst performing month of the year. So having a strong 2% gain in a month that historically underperforms after multiple months of continuous gains is definitely saying that, well, the market is healthy, or at least the market is thinking that gains are justified. But I will reiterate my caution that it might be reasonable to see some losses in the coming months, and it's not anything that should be concerning. It's natural market behavior for fluctuations to go up and down, but it's always good to be educated and to know that there are potential risks or potential drawbacks in the horizon, and as long as we remember to stay invested for the long term, that is usually the best advice that academics will tell you, looking back at historical returns. Other than the mega caps and the S&P 500, small caps have continued to underperform as they have in the past few years, since there was a banking crisis, or the fear of banking crisis. A lot of the small cap stocks are made up of these regional banks, and the regional banks pulled back a little bit while the rest of the small caps had pretty good returns that came out to around an average of 0.8%. Global ex-US, so non-US stocks, actually outperformed the US markets for once. Historically, they underperform, and I still believe that they will likely continue to underperform US markets. But month to month, things change depending on who is fighting a war with whom, or how various trade deals or just supply chains work out. But ex-US, non-US stocks actually outperformed. So for those of you that have some exposure to international stocks, it finally had a little bit of a positive impact on your portfolio, at least relative to US companies. Aggregate bond return for the month was 1.25%. Nothing too special to say about bonds. Usually they don't fluctuate that much and they return all right. Basic expected returns that are consistent. That's why you would invest in a bond. And aggregate bonds being up 1.25 is slightly better than average. And that has to do with the federal rate cuts that we'll discuss in a little bit. Gold was up 5%, still continuing to outperform this year. I think it's still catching up. During the pandemic, it underperformed when most pundits and analysts and economists thought that gold should be performing well. Throughout the pandemic, for some reason, gold underperformed, and it seems like gold is catching up now and beating the market throughout this year. Crude oil down 7%. Interesting to see, especially with continued conflict in the Middle East and hurricanes and port strikes. But just recently, the past few days, that number is from month end of September, so September 30th. Just in the past, yesterday and today, crude oil has jumped up due to concerns with supply chains with Hurricane Helene and supply chains with the port strike, which we'll discuss, and the Iran shooting missiles at Tel Aviv in Israel. So we'll probably see crude oil fluctuate quite a bit until the end of the year. But we'll see. We've had crude oil falling for most of the year, so it's nothing that should be too concerning for most Americans. And Bitcoin was up 8%, just as an additional. It beat everything, every one of these indices, but Bitcoin's volatile. Some months it's up quite a bit, some months it's down quite a bit. Year to date, it follows a lot of what happened this month. The S&P 500 being in between the Dow Jones and the mega caps, where the mega caps are making most of the gains, which is what's pulling the S&P 500 up. Small caps lagging the larger companies. Ex-US underperforming the US markets, unlike this month, but that is what we expect to see in the longer term, that non-US stocks underperform. Aggregate bond return was 4.6% for year to date. Gold, there's that 28%, a very strong number for a year to date gold return. Again, making up for what had been underperformance during the pandemic. Crude oil year to date about flat, negative 5% is flat for oil. But this month was that 7-8% drop. So we are seeing most of the losses having come recently and it being flat for the rest of the year. Bitcoin up 50%, 8% of that being just happening just now this month, but still lots of volatility, lots of returns, sometimes lots of losses. What is to be expected for these cryptocurrencies? I'll quickly show this S&P 500 chart. This month of October, after we had this little dip in the beginning right here, really has been just very clean upward trajectory, green days almost every single day, with a bigger jump when the Federal Reserve had a unexpectedly large rate cut, which we'll discuss more. But you can see these are some larger, what we call candles. So each of these represents a day. So there's more volatility and more gains, and it slowly tapers out and starts hitting what we call a ceiling, and it's starting to dip down in the past couple of days. I wouldn't be surprised if we give up some returns as you reach some resistance here. So again, nothing to be worried about. It's normal for volatility in the markets, and always remember to zoom out. Don't anchor your expectations to this top number, all-time highs. Remember where we came from. Just in the beginning of the year, we were at 4,800, and now we're almost 1,000 points up on the S&P 500. So that's almost 20%. So very significant gains that have happened. And if we lost 20%, we went back down to 4,800. I'm sure everyone would be freaking out. But remember, we were not that long ago much lower. So it's always good to keep it in context. For those of you that haven't seen this chart before, I like to show it to explain the cyclicality and the seasonality of the stock market. I had warned in July and in August that we might have some losses in September because we had such strong gains during months that aren't historically very strong. And there might be, some pent up selling. Citrus has come to say hello again. Some pent up gain or some pent up potential losses. But you can see this is the worst month historically. But we had a 2.1% return for the S&P 500 this month, bringing the year-to-date return of 21.7. When we look at historical returns, it's around 8, 9, 10%, depending on the time period you're looking at for long-term returns on the S&P 500. So we are well in the very strong year category. That even if we had losses for the next 3 months to close out the year, we're probably closing as an above average year, which is nice to see, and ideally will be able to be continued and will be a sustainable type of growth. All right, so let us finally wrap up the webinar here, talking about the notable events for the past month. In the finance world, especially before some of the strikes and the hurricane happened near the end of the month, what we were mostly focused on was what the Federal Reserve was going to do with interest rates, and if they're going to cut interest rates and by how much. The expectation most market analysts and economists had was that the Federal Reserve was going to start rate cuts at 25 basis points. That's what they had done the inverse of when they started raising interest rates. They started with a 25 basis point cut or raise, and then as time progressed and they had more confidence, they started raising faster at 50 basis points. Here we were at zero, flat, no changes for months, and then the Federal Reserve was expected to do the first 25 basis point cut, but instead they surprised the markets and they cut by 50. So in general, the market seemed to see this as a positive sign. When the Federal Reserve cuts interest rates, is meant to stimulate the economy. But where we are currently at the 5% rates was we were in a restrictive type of interest rate environment. So they had raised the rates so that demand would fall to combat inflation, which they did successfully. Inflation came down. We're at around 2.4%, I believe, for inflation. So it's a much healthier and sustainable and safe inflation rate. But when you get into the 4 and 5s, that's usually considered a restrictive level of interest rates because borrowing becomes much more expensive, which tamps down demand. And if you keep the economy in this restrictive territory for too long, it'll force a recession to happen because there isn't the money supply and the demand to be able to sustain growth. So the question was, all right, if the neutral rate is around 3%. So if we want to get the interest rates back to 3 or 3.5% so that the economy isn't being either stimulated at 0% rates or contracted at 5% rates, let's see how long it was going to end up taking for them to bring these rates back down. And if they waited too long to start cutting, or if they would cut very slowly, 25 basis points at a time over many, many months, what could happen is they could overshoot their restrictiveness and again cause a recession. So the Federal Reserve didn't want this to happen, so they started right out the bat at a 50 basis point rate cut. I don't have much to say about it other than I think it was probably a good move. The fear of doing a 50 basis point rate cut right right at the beginning of the cutting cycle was that it would show fear to those in the markets, and that, oh, the Federal Reserve is afraid that the recession is imminent, which is why they're cutting so aggressively to stimulate the economy. But it seemed that Jerome Powell, during his questioning in his speech, reassured market participants and economists and analysts when he was saying, well, we don't want to get behind, and we believe that interest or inflation is where it should be, and we don't want to start having problems being caused with unemployment and such, because these rate cuts have lags with the effect. They cut the rates now, but it doesn't actually affect the underlying economy for, say, 6 months, because people borrow money over time and then they only start paying back the loans over time, and that interest is backward looking. The cost of the loan doesn't start hitting someone's pocket and reducing demand until later. So ideally, they're cutting now, and they're cutting more aggressively so that they get ahead of the potential recession. But right now, everything's looking good. Of course, things can change, and there are no guarantees. But I will keep you updated as they continue rate cuts. In the next couple months, we'll probably see another 25, another 50, or potentially 25 basis point cuts as they continue their cycle. So the next big event that happened was, of course, Hurricane Helene. It was quite terrible. It made landfall in Florida and then continued to Georgia. And based on most of the news headlines, it seemed to have done most of its damage in North Carolina with just horrific flooding. The latest statistic or number that I saw before starting the webinar was that there's about 170 confirmed dead, with hundreds more still missing. Of course, flooding is sometimes hard to find whether someone is just stranded or if there's a body somewhere. So, of course, it's terrible, loss of life. And from our finance perspective of this webinar, there's likely going to be continued supply chain impacts. There were, of course, gas pipelines that ran through Georgia and Florida and South and North Carolina. There were, sorry, my cat's jumping up and down. There are lots of infrastructure, railroads, and highways where trucks run, and ports, and all this kind of stuff. So all rebuilding some of these pipelines or railroads or whatever infrastructure there is that creates these supply chains could take months or years. So unfortunately, this might have some impact on our economy, on people's lives and jobs, on the stock market, but it'll be hard to say what the impact actually will be until after the fact. It's hard to predict the impact of these sudden weather events on the greater economy for the long term. Two other big mentions for causing supply chain issues are these big worker strikes that happened this month, where earlier this month we saw Boeing factory workers, more than 30,000 Boeing factory workers, which is the company's largest unionized group. Of course, these companies that they're so large, they actually have multiple different unions, where you have, these are just the factory workers. If we're talking about the engineers that design the planes, the different unions. So just the factory workers walked off the job, and this is the first time they did it since 2008. This work stoppage like halts most of the production that Boeing does. It is impacting their best-selling aircraft, the 737 MAX. So that production line has halted. And based on what I looked, we haven't heard many updates, but it seems like the strike is still ongoing, and they're still not working, and they haven't come to a deal between the union and management. Similar with the longshoreman strike, it just started on Tuesday at midnight, approximately 50,000. So between the two of them, 80,000 workers that normally are part of the economy just aren't working. So 50,000 workers of the International Longshoremen Association union, they walked off the job, and this was the first time since 1977 that they walked off the job. For the Boeing was 2008. Here, 1977, it's almost 50 years of continuous work, and this is their first coordinated strike. And this, of all of these, it's hard to say whether or not it'll be Helene or this longshoreman strike that will have more of an impact. It really depends on how long this ILA strike lasts. But if this lasts for weeks, or I don't think it'll go to months, but if it lasts months, it would be devastating. There's billions in trade that will be stranded on the water waiting to be loaded or unloaded. And some statistics, between 43 and 49% of all US imports come through these ports in the Gulf Coast and the East Coast, and billions of dollars of trade move monthly through these ports. So if this lasts for a long time, it could definitely cause supply chain issues, re-emerge inflation, at least regionally or potentially nationally. It's quite significant. Of all the strikes that we've seen, this will likely have the most impact if it isn't resolved quickly. Yeah, I don't remember the exact statistic, and this is like a rule of thumb, but I had heard one analyst talking about disruption in port activity, which was going back to like during the pandemic, and now is, I think he had quoted, every day that there is a strike, so every day that there is not full work, it equates to about a week of delays and delayed unloading and such, because the ships continue to come, and then there's a big backlog, and then as there's more and more that is built up and behind. As one ship comes and it gets unloaded, it also gets reloaded with something else that gets sent somewhere else. So if there's a whole lot that is waiting to be loaded, and there's a whole lot to be waited to be unloaded, it causes more and more compounding effects with these delays. So we will see how all of this turns out. Hopefully the longshoremen and the port operators come to some level of agreement, and hopefully quickly, because this is actually what I would consider material or a significant risk to the markets. But again, before anyone freaks out too much, the markets have had a great past year, a great past 2 years. It's important to remember where we are from. So if there are losses in the horizon, it's natural, it's normal, and it's nothing to freak out about. Hopefully it'll be gentle. If we do see losses, it'll be a slow loss instead of big drops where people can leave the markets and then end up missing out on gains throughout their lives. So those are the 4 main notable events that I wanted to cover this month. Not too much from a finance perspective that happened in the markets, but especially these strikes and the hurricane, definitely impactful from a human event point of view. So I had seen one question come in, but I answered that through one of my when I was talking about the hurricanes. So I don't see any other questions coming in. So I'm going to wait 10-15 seconds. If I don't see anything, I'll be wrapping it up for tonight. I want to thank you all that attended. Please come back next month. Hopefully I'll have continued good news to share. And I'm wishing all of you a happy and productive month of October, or a spooky month of October if you celebrate Halloween. That's another good one. All right. Have a great night, everyone.